Hey there, welcome to the show. I'm Mitch Goldberg with Client First Strategy. The show is called Be the Boss of Your Money. Couple of things. I'm not here to predict. I'm not here to tell you which stock that you should buy. We don't sit here and say we're making we're not making a call to say you need to buy right now. The S&P is going to turn around tomorrow or you know, a lot of calls. I think, we would probably get a lot more media attention and more viewership uh, hmm, if we made more bold calls. But that's not the point of the show. The point of the call is to educate you and to share insights with you. An insightful show where you sit back and you go, yeah, let me think about that. That makes a lot of sense. I think I am better off for hearing that. That's what this show is all about. So when we get into, the markets and when the market was down 20% from its all-time high about a month and a half ago, we were calm, cool, collective, and cash on the show. I didn't get your feathers ruffled. I gave you the advice that you would give to anyone else. It's just that sometimes we don't act logically, and that has to do with the stock market and politics, geopolitics, and a lot of emotions. And people make decisions like getting out of the market too much when they have a lot of runway left to be a long-term investor, or they where they change their investments to reflect like a nuclear winter for the stock market, and they're just going to hide out and let the storm pass. I don't like to get into hyperbole and make these kinds of calls because I don't think they make sense, and I don't think it's helpful. We're going to talk about I said two things, but a couple of things that you could do now since the stock market has recovered. So let's take a look at the intro. We're going to get into a couple of things. And this is going to be a very informative show. And I think you're going to learn a lot from this. So stick around, and here we go. All right, it's good to have you today. I'm Mitch Goldberg with the wealth management firm Client First Strategy. The show is Be the Boss of Your Money. It's all about financial education. I just feel like the more I share, the better my life gets. It's the abundance attitude. Okay. So I want to show you something. I think lost in all the sauce today. President Trump in Saudi Arabia lifting sanctions, all sanctions on Syria. Because the U.S. is considered Syria a terrorist nation with massive sanctions since 1979. The Bashar regime, it's just been an awful, evil place. But President Trump is giving Syria a chance. The government there has been overthrown. The civil war has ended, and maybe we have a new real country and a dove in the Middle East. Hundreds of billions of dollars of potential business transactions announced uh, with Saudi Arabia. And, so President Trump is globetrotting now, bringing in deals. Uh, Listen, I'm the first one to say this show is about the economics uh, of policy, of markets, of investor psychology, GDP, inflation, interest rates, all these things. Geopolitics has a lot to do with it. And when I see something in geopolitics that worries the market, that scares the market, that makes the market go down, I will tell you about it, give you my insights, my perspectives, because I've been doing this for 35 years. So I know a lot, I've seen a lot, and I have a lot of experience from which to draw from. I've helped lots of clients overcome challenges, and I've seen how clients have overcome challenges on their own before they even met me. So it's I have a lot to offer that way. So When something's good, we'll say it. When something's not so good, we'll say it. When something is needs reporting on, I'm going to tell you. And I'm independent here. I don't care what uniform the policymaker is wearing. Some policies are good, some aren't. Mostly though, there's nothing you and I can do about policies. We can only adjust, react, and move on. So let's talk about the stock market. People sold, people got worried about tariffs, and they made a lot of changes to their investments. And some people shouldn't have done it because they have a long time until retirement. They're still long term investors. And even if you're not, let's say, what you would consider a long term investor, you're already 5 to 10 years into retirement, you are still investing for the years to come because of inflation and because it's what you want to do is you want to grow your wealth because your expenses are growing. Now I hear you, but if the stock market goes down, not only did you not grow your wealth, you're behind the eight ball because whether if the stock market goes up or down, inflation keeps going up. The cost of food is going up. Even if inflation is low, it's still typically positive, right? So it's still going up. And that's why we say you've got to be a long-term investor. And some of that money, you just have to trust that your investments will grow over time. If you're in a position when you need the money in advance and you don't take that money out of risk assets like the stock market, you're running the risk of selling it to a down market, locking in a loss, and having less money for your lifestyle, for your expenses, for the rest of your life. This is why the first thing to do now is this since the stock market's rallied, all right, just again to show you, all right, look at this, what I'm about to highlight over here, okay? The stock market is up now, barely up, but still, it's at least, okay, it's up this year. Okay, you don't want to say, you don't want to give that, uh, you know, 0.8 a score. Okay, well, let's call it flat. And from its all-time high for the S&P 500, another 4.25%, we're at record highs. I mean, we could be a week or two from hitting an all-time high in the stock market. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So let's talk about the first thing to do. If you are nervous and you are really frightened about the stock market, and you are somebody, I'm going to use an average age, let's arrange 55, 60, 65, and you got really, really frightened about how the down market would affect you financially for the rest of your life. Now that the stock market is pretty much recovered, even if you're in individual stocks, you should have been recovered by now. Your investment should have recovered. Uh, if that's you, then you could use this moment to rebalance and say maybe, being 70 or 80 or 90% in the stock market is too much for me. And maybe use this as an opportunity, a teachable moment to reduce your stock market exposure. To say maybe you only need to be 60% in the stock market or 50% in the stock market, or maybe you are, and now you could use this opportunity to rebalance your portfolio. And some of you might be too little into the stock market. And this is a time to reconsider and say, the market's recovered as they typically do. Maybe I need to put more money into the market. But don't let this opportunity go to waste. Don't let the fear that you had for the last couple of months with tariffs and geopolitics, don't let that fear just go away and say it was all for nothing. Use it to your advantage. This could be the opportunity that you need, the little kick in the butt that you need to rebalance and reconfigure your investments so that they really are more in alignment with your time horizon to the time of when you start to when you start to use your money to pay your bills. We always talk about your investment time horizon, and that's like you could ask 100 people what investment time horizon means, and you're going to get maybe not 100 answers, but you'll probably get like 80 or 90 different answers, right? When I say time horizon, the way we use it here at Client First is that's the time when you start to have to when you start needing to use your investment money. It's the time when you need to convert that into cash to pay for your bills. So when you're working, you're trading your time for money. That money, some of it goes into investments, retirement plans, which goes into the stock market. And then when you turn a certain age, you start to need to trade your money for time. At that point, that's your time horizon. And what we do is we get the glide path to that point, we get it started much earlier. So if you're going to retire, let's say at 66 years old, and that's when you're going to be the age when you're going to start converting your investments into cash to pay for your bills, to pay for your real estate taxes and your food and everything else that you spend money, your vacations, etc., your golf habit, whatever it may be. We start that glide path. Let's say you're going to retire at 66. We're going to start that glide path at around 56. And we're going to start getting you less in stocks and a little bit more into stable assets. Could be cash, could be bonds, the type of investments that will be there for you. So if we do have a really severe down market that stays down for a couple of years, we want to be ahead of that so you don't have to sell into a down market. Because not only do you have to sell more shares of stock or exchange traded funds or mutual funds to pay for your bills when the market goes down, mathematically, that's how it works. Now you have fewer shares working for you so that when the stock market eventually, and I have to say potentially recovers, you won't have as many shares working for you, which means your asset size won't recover as much as you need it to. So this is why we start the glide path early. So number one, use this opportunity with the stock market recovered now that's up slightly in the year, and we're barely down from highs. Use this moment to think about how you felt the last few months. And maybe now is a time that you need to reconfigure investments, reconfigure them into a more conservative portfolio that could better serve your future. And if you're, let's say, 40, I'm just using ballpark ranges because this is just general information. This is not investment advice for you. If you do want specific investment advice, you know what to do. You have to reach out to me. You could call me, you could email me, you could DM me, but I'd rather you call or email, okay? I'm more likely to see that than if you just send me a DM, because I get so many DMs from so much junk, spam, that I mostly do not look at those anymore. So another thing you could do is you could see what kind of junk you had in your portfolio. And maybe some of the stuff that you had, which was down a lot, is no longer worth keeping. Use this moment to upgrade your portfolio into best of breed investments. Maybe you have a high cost mutual fund. Maybe now is a good time to switch that into a low cost fund or another option with less fees, but that basically has the same or a very similar investment objective. So another thing you could do. One more thing that I think you should do is look at the overall portfolio that you have, and not just between stocks and bonds and cash. Maybe, for example, you were 80% stock. Maybe you really should be 60% stock and 40% bonds and cash. Within that 60% of stocks, see where that part of the portfolio should be. Maybe that part of the portfolio should be more heavily skewed toward dividend payers, preferred stocks, utilities, and maybe a little bit less into other economically sensitive sectors like consumer discretionary, industrials, and technology. Consumer discretionary are companies that consumers buy. Okay, they make things and services that consumers buy, and that would include like a Lululemon, Harley Davidson. These are not consumer staples. These are things that you want, and we all know that if you want something badly enough, it does become a need, right? Another thing that you could do is if you feel that you were underinvested in the stock market, and this is the last point I'm going to make. If you were underinvested in the stock market, and now you're looking at how much everything went up and you just took a lot of money out of the stock market, and you really are just like kicking yourself. I shouldn't have sold so much. The market's back up. I just gave, if you had $1 million in your portfolio and it went down to 900,000, and now you're like that out of that 900,000, like 80 or 90% of it is in, T bills and cash and money markets. And now the market's gone up, you know, and now that the market's recovered, you really need to ask yourself, why did you get so conservative, so nervous? Clearly, you did not have the right portfolio for you. You may have had at one point the best portfolio for capital appreciation, but that doesn't really mean anything if you can't stick with it. Maybe that portfolio capital appreciation deal was meant for you to hold on for 10 or 20 or 30 years. So, what you could do, though, to get back into the market is use something called a buy limit order. So, for example, if an ETF that's tracking a major index is $100 a share and you want to buy 100 shares, $10,000, you could buy 40 shares right now at the market, 40 shares of $100 ETF or stock to $4,000, and then buy 30 shares with a limit order. So if the stock or ETF drops 3%, you buy another 30 shares. If it drops again 3%, you buy another 30 shares. This way, you're potentially using stock market volatility to your advantage. If you feel like you're chasing and you miss better prices, at least now you're giving yourself a shot to buy in at lower prices. And if the stock market keeps going up and you didn't buy enough, so be it. You have a first class problem, a really nice problem that you don't have enough in a winter, as opposed to having too much money, as opposed to having too much money in the stock market. And the stock market takes a big dip. You sell because you're nervous, and then the market goes back up. Because when has the market not recovered from a bear market or from a scare? When has the market not recovered? You can't even answer that because it's always recovered. The question is, will it go down when you're 65 and not recover until you're 75? Right? That's the question. Will it go down when you're 50 and not recover till you're 70, like a very long, prolonged, dragged out down market? It could happen, but even if it's just for a couple of years, and you're right when you retire, now you have to take money out of the market in the first few years of retirement when the market's down. You have to take money out of your portfolio. That's when it really hurts. This is why we do the glide path. This is why we make sure your asset allocation according to your time horizon to the point when you have to start using your investments to convert into cash to pay your bills. That's most important. And then if you miss the market and you want to get back into your stocks or your exchange traded funds, but you're worried about chasing the market, you can use buy limit orders at prices below where they are now and maybe capture some of the advantage of volatility, potentially turning volatility into your advantage. And it would be a normal thing for the market to have a big rally like it just did and pull back a little bit. I can't tell you when that's going to be. That's the problem. So this way we compromise. Buy a little at the market, buy a little more on a limit order, buy a little more on a below the market limit order. These are the kinds of things that you could do to get back into the market. Jerry, I see you out there. Thanks so much, buddy, for your support. We have to catch up soon. I'm going to get going now, and I am actually starving. So I'm going to get out of here and get something to eat. See you all tomorrow. Thanks.